There's been much talk about the U.S. debt ceiling crisis over the course of the past week. Today I'm here to unpack what the U.S. debt ceiling is, what causes it, and how it affects mortgage interest rates. The U.S. debt ceiling is a political and economic event that happens when the government runs out of money that it's allowed to borrow. The debt ceiling is set by Congress, and it is currently $31.4 trillion. Unfortunately, the U.S. currently runs a deficit, which means we spend more money than we make. And let me tell you, we've actually raised the debt ceiling 78 times in history. To keep it simple, let me tell you, we are actually gonna raise it a 79th time. We just don't know when. It'll likely come before June 1st. Now that we know what the U.S. debt ceiling is, let's dig into how it's affecting mortgage interest rates. First, we must start with Treasury bills. Treasury bills are basically the good faith and credit of the U.S. government. If you buy a U.S. bond, the government is promising to pay you back a return. Bonds vary off of duration. It can be a 1-week bond, it can be a 1-month bond, a 3-month, a year, 10-year, 30-year bonds. Essentially, mortgage interest rates are directly affected by the U.S. 10-year Treasury bond. So remember, these bonds, again, are the good faith and credit of the U.S. government. You're being promised you're gonna receive a return. However, if we don't have a debt ceiling agreed upon, there's no guarantee that those bonds are actually gonna receive the payments that you should be receiving because the U.S. government has promised. Because of this risk-free asset, this U.S. bond, is now a risk asset. So because it's a risk asset, this drives the price of the bond up, thus increasing interest rates. Remember, if you were investing in something and it was a riskier asset, you would like a higher premium of return because you are uncertain if that investment is gonna be successful. If you were guaranteed a return, well then you wouldn't need as high of a return. And that is essentially the dilemma we're in with bonds. Again, bonds, normally a risk-free asset, guaranteed to be promised to be delivered. However, at this moment, it is not promised, thus driving interest rates up, thus causing a lot of problems for us currently. However, we do fully anticipate that there will be a debt ceiling agreed upon by June 1st. Hopefully this can bring some relief to interest rates over the course of the next few days. Again, we're not promising lower rates. We're just hoping that once this is reached, we can see a stabilized interest rate as we know we have an agreed upon debt ceiling. Thanks for tuning in. Stay tuned for another weekly market update next week when hopefully we have an agreed upon debt ceiling.